Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with David Ingles.
Good morning. Let's get to your top stories today. The yen edging higher with Japan's ruling coalition set to lose its upper majority. In the upper house here, Prime Minister Ishiba saying he will stay on despite the historic setback.
Yeah, Chinese banks are set to hold their prime lending rates today as investors focus on trade talks and upcoming earnings. Singapore stocks, meanwhile, on their longest winning streak in 19 years.
And China's vice finance minister says domestic consumption is driving growth as he defends Beijing's economic policies against Western claims of overcapacity.
All right, we start with some breaking news here this hour, and it is the LPR in China. So unchanged for both the 1 year as well as the 5 year as expected. So 3% for the 1 year that holds, 3.5% for that loan prime rate for the 5 year as well. Really not surprising, just given the fact that what we've been seeing, they basically have held and stood pat since that cut back in May as well. And given, the really concern around banks, right, and the narrow net interest margins, there really isn't that strong incentive to really continue to cut further here as well. And the data has been looking pretty okay of late too, Dave.
Yeah, I mean, the first half data north of 5%. We've had economists, of course, revise higher their forecast there. So the about 5% growth target seems to be something that is achievable given the current telemetry of things. The other thing we want to talk about right now as we go into the market open for today is, well, a couple of things, right? So Japan is shut, number one. Big news out of Japan, so we're looking at some of the proxies elsewhere, although you do have futures up and running there as well. Let's have a look at how we're doing across Asia Pacific. You have U.S. futures. You have Singapore actually coming online right now. We can get it up. Thank you so much. And we are, in fact, opening up again after 10 days of gains. So we're now looking at the longest win streak in 19 years in Singapore. Straits Times Index, there we go, 0.1% of 1%, 0.2% of 1% to the upside right now. Right, Japan, we'll unpack the story for you later on. The question is really, will what's been happening domestically affect what they're able to do internationally when it comes to the trade policies and trade negotiations there. We're looking at Nikkei futures mix, slightly to the downside. Yen strength, of course, coming through. A gap higher on dollar-yen, gap lower, rather, on dollar-yen earlier on. We've since retraced most of our steps, but we're still trading on the stronger side of the cutoff this Monday morning. Brief look at the currency markets. Nothing much to tell you about right now. There's a lot on deck, though, this week. Central bank decisions, minutes coming through. RBI, I believe, is also coming out as well. We are on the stronger side of the recent range as it pertains to the Hong Kong dollar. So we'll talk about HIBOR in a moment. Maybe less need or less expectations of a further melt up there as far as HIBOR is concerned. And very quickly, one pocket of the market we're tracking closely today is commodities, metals specifically in China. And as you can see, iron ore and Dalian is now trading at 800. And we've seen a lot of these contracts rally recently. Maybe it's because of the growth figures. We'll see.
Yeah, that's certainly maybe helping the demand picture out there out of China as well. But let's get to our top story this morning. Japan's Prime Minister Ishiba says he will stay in office despite NHK reporting that his ruling coalition lost its upper house majority in Sunday's election. Now, this marks the first time since 1955 the Liberal Democratic Party will govern without control of both chambers. Let's bring in our news desk editor Jill Dees. She's with us to talk about this historic sort of shift that we're seeing coming out through here. But I remember it was like the last three prime ministers who lost the majority has basically stepped down within a few months. He still wants to stay on. Can he?
Yes, well, Yvonne, I think it's obviously going to be incredibly difficult for Ishiba. A couple of things sort of working, I guess, in his favor, although, again, it's very difficult to even really use that term when obviously this is a pretty tremendous setback, particularly following his loss in the lower house last year. But essentially what we've got is, the opposition parties have managed to obviously take in some votes. A lot of them were campaigning on, a lot of domestic issues, including wanting sales tax cuts and such. But there's not not really a big, broad coalition to, I guess, ultimately supplant Ishiba. The other thing, too, is that one reason why he may be pretty, strongly trying to hang on for now is because we've got this U.S. trade deal negotiation that is still continues on. I mean, if Ishiba were to step down, you'd have to imagine that there would still be a leadership election, that kind of puts Japan in a fairly weak position. So I do think that's one consideration here. But yes, I think, Yvonne, as you mentioned, in a situation like this, it's kind of hard to see, the prime minister holding on for more than a few months, if that.
To the point you're making, does this adversely affect materially the outlook or the outlook for any potential trade deal with the U.S., though?
I mean, I think that at this point, David, the negotiations between the U.S. and Japan have not been going particularly well as it is. There's still a lot of sticking points over the auto sector in particular. Yeah. I mean, we know that the Japan has sent their trade negotiator to the U.S. many, many times trying to get something over the line. We've also just heard from a lot of other nations, other economies that are trying to do business, trying to negotiate with the U.S. right now, that Trump seems to have kind of hardened his stance about new trade deals ahead of this August 1st deadline. So I'm not really sure, what we were, going to really have from Japan in the works. But you do have to imagine that if Japan loses its current prime minister, the one that's been, really overseeing a lot of these negotiations over really about, roughly the past several months. I mean, certainly since the start of the year, certainly since Trump was elected. If you lose that figure and then you have sort of a power vacuum or some kind of a, debate over who's actually is going to step in, that leaves Japan in a pretty weak position as it is. But again, I think that when you do have this kind of a loss at home, if you're Ishiba, there's got to be some kind of a consideration as to how exactly you continue to govern. Is it you try to focus on certain issues and get things over the line sort of piece by piece at home while trying to negotiate these deals abroad? Obviously, really tough situation for Ishiba to be in.
Yeah, there we go. Plus, of course, inflation's rising as well, which doesn't tend to favor, of course, incumbents. Jill, thank you so much. Jill Desis, our news desk editor. I talked about inflation. Tokyo CPI is on deck this week in Japan. Alongside that, you have a 40-year bond auction in a couple of days as well. Stronger yen as we make our way into the fresh trading week. Mark Cranfield is with us out of Singapore to talk us through all these key themes. Mark, the yen is on the stronger side if you compare it to Friday. With everything that's on deck this week, is the path of least resistance stronger for the Japanese currency?
Not much chance of that. I mean, 0.2% after the election, you would think it was priced in, but I mean, there's just a host of things which the Japanese yen has up against it. So let's start with negative yields. Negative yields are a very big problem for Japan, and the Bank of Japan is in no position to tighten policy. When they have their meeting this month, it's pretty clear that nobody's expecting them to change rates. And the trouble is, when Governor Ueda speaks, he probably can't even afford to sound hawkish. He's got a political mess at home, as you've just been talking about. Jill was just talking about the problems from the election, the fallout from the weekend. They don't have a trade deal with the United States, and it looks as though that will go to the wire, which means that it will probably, the risk of it is still running by the time the Bank of Japan meet at the end of next week. And on top of all of that, you've got the fact that the yen is beginning to be used again as a currency to short against other major currencies. There's just too many factors falling into place against the Japanese currency. It's probably not, if it wasn't a Tokyo holiday today, dollar yen would probably be a lot higher already. Just the fact that we've taken a big chunk of liquidity out of the market, and people are probably a little bit wary about pushing positions one way or the other. And we don't have a Japanese bond market either for them to look at, or the equity market. So if you put all that in place, it's surprising that the yen even managed to rally 0.2%. It probably won't last very long.
Yeah, well, we'll see how that whole bond auction plays out this week as well. And then there's the rest of these markets, Mark, and I look at stocks, and it's like everything's fine, right? We're still talking about records in the U.S. We just talked about Singapore and the longest winning streak in 19 years. You could say that for many other markets here in Asia as well. Does any of this look too good to be true right now?
Yeah, I mean, some people are talking about the fact that some indicators like RSI on the Singapore index is running at something like 88, which may be the highest it's ever recorded. It's certainly a very high extreme number. By now, you would have thought people might have been starting to dial back. But significantly, if you look at equity markets in general, It's the rebound since the beginning of April, which is driving so much of the sentiment. It's not just Singapore. If you look at the way that the Korean index, Hong Kong, S&P 500 itself, all of these major indices, the extent of the rebound since the first week of April when we had the Liberation Day slide is really quite dramatic, and it's across the board, and there's no signs of it flagging in the other bigger markets. So if you look at the Straits Times Index itself, it's up about 23% since April, but the Kospi is up 40%, S&P is up 30%, Hong Kong's up more than 30% as well. So the STI is actually lagging a lot of its peers, even though it looks as though it's having an extraordinary run. It is by its own conditions, but compared to other markets, it doesn't look as though it's gone that far, really. So it just shows you it is something which is feeding on itself across the world. And until that momentum, particularly in the United States, until that slows down, everybody else looks like there's relative value. So even the Straits Times, after 2 decades worth of extraordinary performance, even that doesn't look as though it's got too crazy.
Mark, we're flashing on the screen some of the major items on this week's agenda that's going to come up for our viewers again in a moment here. Mark, what's top of mind for you apart from everything that we've talked about already?
The one that you don't have on the screen, the 40-year Japanese bond auction. I mean, we've had so much talk. About
you walked into that door.
How do we miss that one?
There's been so much talk about risks to the long end of global bond markets, and we have a 40-year JGB auction amid all of this uncertainty that's going on in Japan. If there's going to be a tail risk for G10 bond markets especially, it's something going wrong with that 40-year auction. The yields have risen quite a lot. And you might say that discounts already a lot of bad news, and maybe that's when long-term investors can come back in. I'm not quite so sure, because if you look at the discrepancy, since a lot of these 40-year bonds which are trading off the run now are trading 150 or 160 basis points away from where they're on the run. That's a very unusual discrepancy, and it means that people don't have an incentive to go into the new bonds because the cash losses on the old bonds will be just too high. So natural demand for this week's 40-year auction is not going to be that good. And unless we get some very reassuring messages coming out from the Japanese authorities, there's a chance that this will just spur another sell-off in global long bond yield. So watch out for that 40-year auction. And maybe you should put it on your little screen that you had just there.
Oh, well, Mark, you know what? That's going to come up on our little screen. Let's give it 15 minutes until we correct that. Mark, thank you so much. Mark Cranfield. That's Wednesday, of course, comes out at 40-year bond auction in Singapore for us. Right, coming up here on the China Show, speaking of fixed income, that's something we'll talk about, certainly, and maybe the graphic will be ready by then. With JPMorgan Asset Management, Jason Pang joins us at about this time in the next hour to talk us through all things fixed income in light, of course, of where you are with the trajectory of inflation and, of course, new tariff deals. Cutting out the open of trade in Shanghai, in Shenzhen, and here in Hong Kong. This is the China Show. Right, so we're just coming off some extreme weather on the weekend here in Hong Kong. Still remnants, more than it at least, when you look at what's taking place outside. Although the typhoon signals, I believe, have gone away. We have a rainstorm warning still, though.
Yeah, all lowered this morning, but certainly the cleanup efforts are underway. There's certainly a lot of debris when I was on my way to work here this morning. But yeah, how quickly things change, right? I woke up yesterday morning, it was a T9. Yeah. I think within minutes, T10. And it definitely felt like one from Typhoon Whippa, which almost kind of sounded like what happened there. Whippa.
It almost sounded like that, yeah. Quite quick and rapid, and it was the first in a long time that almost a direct hit on Hong Kong. So we did have the highest typhoon signal warning here over the city, and hopefully, of course, the backlog of flights have been mostly, if not hopefully all.
I think Cathay is resuming flights already.
There we go. We do have some colleagues, of course, got stuck as well. Anyway. Other things on the agenda today, apart from the cleanup efforts here in Hong Kong, CPI is coming out of Hong Kong. HIBOR, we talked about this, has been on the upside of late, but we're trading on the stronger side now on the recent range of dollar honky, so that should alleviate some of the upward pressure there. Also want to watch silently, the CSI 300 is now the highest level since November of last year, and that's being accompanied by turnover that's picked up as well, $1.5 trillion on Friday of turnover onshore.
Okay, maybe a bit more momentum momentum on that side of things here as well. But let's get to one of our big Bloomberg scoops here. A senior Chinese official says that China's trade with the world is within reasonable bounds, and the nation is not out of to dominate global markets. Let's bring in our China correspondent, Min Lo. Give us some context of this story, this interview. What was said, and what did we hear?
Yeah, so this was said by Vice Finance Minister Leyen, who is actually a key member of the negotiating team who met with Scott Bessent and Howard Lutnick in London and Geneva. And he's saying that Chinese production is targeted at mainly meeting the domestic demand. Yes, of course, if there is demand for Chinese exports, the exporters are going to sell them overseas. But the goal is not to dominate every single market overseas. And he's really trying to counter the accusation by Scott Bessent that China is one of the most imbalanced economies in the world. And he said the Chinese government has been doing its best to transition the economy into a consumption-led one, and it's made some progress. If you look at the statistics, the last 4 years, he said, consumption's share of GDP growth was 56%, which is 8 percentage points higher than the previous 4 years. And he says the government will continue to strengthen the social safety nets, to create more jobs, strengthen the pension system, increase salaries to boost spending over the long run. And I guess he's really trying to set the atmosphere right, or to correct the perception of how people view the Chinese economy.
Yeah, there are two things, right? One is there is certainly a cyclical weak spot right now that might be complicating how they're looking at, whether or not there is enough domestic demand capacity to, take up all the supply. But how much room really is there to expand the domestic market?
Yeah, so if you look at the numbers last year, industrial profits was averaging around 15% or so for the full year. And you look at the tariffs, they're averaging about 40%. So clearly, the tariffs are much higher than the profit margins. And our Bloomberg Economics team has said that they studied 33 sectors. Only 5 sectors, they said, will be able to absorb the impact of tariffs. So they're going to face either bankruptcies at worst, or at best, lower profit margins. And for these companies, they are seeking to look at new markets, whether overseas or domestically. It's really intense, right? The competition, especially if you look at the food delivery platforms. The government just summoned some of the heads of these companies like JD.com, Meituan, to call them to really regulate their promotions, because we're looking at billions of yuan being spent on subsidies for merchants and for consumers. Alibaba coming up with these Super Saturday promotions. You can now go to your app and order a drink for practically almost zero delivery fee. And that's the sort of competition that the government want to rein in, calling on these companies to create the conditions that are beneficial for consumers and merchants, but also for the delivery companies in the long run. The EV sector also facing a lot of scrutiny. The government also meeting with at least 17 representatives of the EV sectors, calling them to rein in the competition. And you can see that the share of the loss-making industrial firms in China has been reaching very high levels, close to the levels that we saw in the 2000s.
Yeah, the key question is how. How do you stop these price wars? Min, thank you. Our China correspondent there, Min Lo, on the latest. And in other news out of the mainland now, we're watching President Trump and Xi Jinping reportedly expected to meet at or before the APEC summit beginning at the end of October in South Korea. Now, this was coming from the South China Morning Post. It's citing sources saying Trump could make a stop in China on his way, or they could meet on the summit sidelines. Sources have told Bloomberg that Trump has been dialing down his confrontational tone with China in hopes of securing a summit. China is tightening controls on critical mineral exports, pledging zero tolerance for smuggling and illegal shipments. State broadcaster CCTV says Beijing's Export Control Office flagged recent cases involving false declarations and transshipments through third countries. China is enforcing stricter licensing for all rare earth shipments amid ongoing trade tensions with the U.S.
Right, just under 9 minutes of the opening bell here. We're looking at, again, gains, and 25,000 is not very much within striking distance. We're now just 9 points below that nice whole round number. Misty, foggy. We're just coming off, of course, a T10 typhoon here in Hong Kong. And looking at the early movers right now, some of the companies that were summoned are some of the companies that are leading these gains right now. There we go on your screens. BYD, Alibaba separately, Alibaba, Meituan, and JD.com, as you can see, substantial gains in the pre-market right now, going into the open today. A fuller preview coming up. This is the China Show. Right, welcome back. The platform companies seem to be leading the early gains right now. So we're looking at 0.7% on the Hang Seng Index. Within that, you have Alibaba, you have JD.com, and you have Meituan, all up about 2 to 4% in the early goings here.
It seems like right now the fact that regulators are really kind of summoning these companies, and you got to do something about these intense competition and these price cuts. That seems to be lifting some of these stocks here. The likes of Jefferies saying that this price guidance may actually aid the sector overall. So certainly this more rational sort of competition is something that people are really focused on here this morning. So we're focusing on that. You mentioned about Singapore, you mentioned about Hong Kong, some of the levels that we're watching. But yeah, it seems like there's still reasons to continue on with this rally here this morning.
Yeah, I mean, we're now looking at the... Oh, why are we looking at Singapore? Oh, yeah, okay. Anyway, let's talk about Singapore. Why not? Because it is hot in Singapore. That's a reference, of course, to the climate. The market is also extremely hot right now. So we've actually never had a 14-day RSI above 87. We're now closing in on 90. And yet again, we're looking at gains still of about 30 points in the Straits Times Index. 25 minutes of the cash market session, and that now takes gains to day number 11 or day number 18 in the last 20 days. Suffice to say, Singapore has barely had a losing day in the last month or so. The other market that's done very well is Hong Kong. Flip the boards, please, if we can, or the charts, and 25,000 is the level that we are getting extremely close to on the Hang Seng Index, and we'll see what the opening looks like. But yeah, 170 points in the pre-markets. It puts us within, of course, that level. And at the moment, we're now trading at about a 3.5-year high on the benchmark here in Hong Kong. A couple of stocks that we're tracking here, too.
Yeah, so we focus on, of course, the tech space. That's certainly one to watch. Given what we've been hearing from regulators and the like here, also what we're checking out is some of the suppliers of Unitree as well. Can we get that up here right now to see what we're looking at? So Baba, Meituan, JD, those are the ones that are actually, we mentioned, seeing the most punchier gains here right now. Kingdee as well. So Unitree suppliers in focus. So the Unitree basically submitting a pre-listing tutoring application. We're watching some of these suppliers. This is the one in the 8-share market. We're just slightly lower this morning. You're watching the China Show. The Open is next. This is Bloomberg.
Welcome back. So we're poised for a higher open, as you can see on your screens. Just before we talk about the markets, though, the cleanup efforts are underway after some very extreme weather, of course, here in Hong Kong over the weekend, in really most parts of Southeast Asia, and then Hong Kong, and of course, following the T10 typhoon, which is a good reminder to get really eggs, like in my case, food shortage at home. But then again, you're forced to then count your calories then. But yeah, it's a good problem to have. But yeah, it's a reminder for many of us.
Yeah, we were stuck at home for most of Sunday, but certainly a lot of time for us to kind of look at these markets. And overall, it's been pretty quiet. But then again, we continue to see, equity rallies around the world. We talked about those milestones that were hit in Singapore, longest winning streak in 19 years. We're watching what goes on in Hong Kong as well. Onshore markets are looking pretty good. We're still seeing upside about 1/3 of 1% here this morning. Dave has been talking about this whole kind of commodities rally that we're seeing, like the likes of copper, like the likes of iron ore and Shanghai crude as well. Look at the iron ore and Dalian. We've reached above that 800 renminbi level here right now. So maybe the whole picture of China and the eco sort of things is really helping overall the commodity space here as well. We're seeing CATL A shares also up 1.5%. So tech seems to be catching a bid here once again. We'll talk a little bit more about what's going on in Hong Kong. But we're watching very closely as well what goes on in Hong Kong when it comes to, yes, it is of course, the post-typhoon. Flights are resuming in Hong Kong overall as well. Cathay Pacific is underway there as well, some of these flights. Flip the boards. We're watching, of course, the key levels in the HSI. 25,000 seems to be within reach now in that level. And really, we're inching closer to that 3.5-year high for Hong Kong. A lot of sort of catalysts, right? You talk about the IPO market. We have Goldman Si Fu joining us in just a few minutes to tell us how the pipeline is really bringing back a lot of sentiment and really improving things here in the city. We're up about 2/3 of 1% with the Hang Seng here. HS Tech, there you go. We're seeing gains early on about more than 1%. 4%. What's been really fueling that, as we were just talking about, the regulator summoning some of these food delivery companies to do something about these price wars, right? So, Jeffries came up with an interesting note saying, this is going to maybe possibly lead to some sort of rational competition in the food delivery space here. That's why you're seeing Meituan up close to 4%, Alibaba up close to 2% right now. And we're watching Meituan and Alibaba and JD as well. Jeffries was saying basically if we start to see more rational competition and maybe the cooling down of these coupons and, 0 renminbi purchases and promotions and the like, it's really going to benefit the likes of Alibaba and Meituan. JD, though, they say, still needs to really work on really bringing out volumes, order volumes. So that's the take from Jeffries there this morning. On the flip side, though, you're seeing Tencent and Xiaomi are heading the opposite direction. Honky dollar still on the weaker side now. We're at 784.89. 8 shares are doing pretty well as well. And so there's a lot of, we'll talk about EVs, for example. Obviously, when you talk about price wars, that's where you're seeing in the EV sector. So the fact that they're tightening this oversight of EV prices and the like here, that certainly is lifting some of these big names as well. NIO is up 1.3%, for example. And we're watching rare earths as well. There's been a lot of talk, of course. This is one of the main sticking points when it comes to, or I guess main topics, I should say, when it comes to these trade negotiations. So they're vowing for zero tolerance for the smuggling of these critical minerals. And you are seeing the likes of Shanghai up close to 3% here today. Dave.
Yeah, there we go. So the market is off to a good start this week. It's another week where, again, we're looking and waiting for more news as it pertains to this red-hot listing market in Hong Kong, whether that's IPOs, whether that's homecoming IPOs from outside, whether that's the A-to-H share, of course, whether that's secondary share listings. So the folks at HKEX have been extremely busy, as with the bankers. So the beers are on you when it comes to bonus season, which is still more than a few months away. But I know some of you are already counting that forthcoming windfall. Speaking of windfall, the money flowing into Hong Kong from mainland China across the Stock Connect. So this is a look at weekly net flows across the southbound Stock Connect. So far, we've only seen 3 negative weeks and 3 barely negative weeks so far. So this is indicative of all this liquidity that's coming into this market, whether that's as a function of the market itself or all, again, the listings that are taking place here in the city. Let's get more context, really, on what's taking place here with Goldman Sachs. China portfolio strategist Si Fu is here with us. They've put out a report on this recent resurgence in the IPO market. And she's here with us to join us to talk us about this report. Good morning.
Good morning.
Yeah, so can it continue?
Yeah.
The good times.
It's exciting to see this year there's a resurgence of the IPO activity. Definitely had boosted sentiment. But more importantly, we are still seeing over 200 companies are in the pipeline that have already submitted their applications for Hong Kong IPO. So definitely it's a good signal that the market sentiment or risk appetite has been increasing. Of course, the important question people may ask is whether the sentiment boost effect is larger or the liquidity impact. So this time we see the positive impact is dominating, mainly because even though we have the number of IPO increased dramatically this year, but it's a recovery of a subdued level in 2023-24. Even if we look at year to date, the net issuance level is still less than 1% of the total market cap, less than 1% of turnover, so the liquidity impact is quite limited. And at the same time, as you just mentioned, we are seeing global capitals are flowing back to Hong Kong. Especially we see this time the cornerstone investors have contributed 42% of the capital raised, and 2/3 is initiating from the global funds, including global pension funds, endowment funds, because their position in China was pretty low in the past 2 years. Very light positioning. Some were even not holding China at this moment. So Hong Kong IPO give them an opportunity to consider rebuild their portfolio, especially with the policy pivot last September and also the AI optimism early this year. We are seeing China is back to their radar, and they are considering to come back to China. So Hong Kong IPO give them a chance.
How should we gauge what these stocks are going to do after its IPO? How do you compare it from last year, for example?
When you look at the performance for the IPO in 2024 24-25 compared with the previous 5 years. Definitely in recent 2 years, the post-IPO performance is much stronger, especially in the 3 months horizon, 1 month or 3 months horizon. In 3 months, over the past 2 years, the post-IPO return is 41% on average, but previously it's around 10% on average. So definitely the performance is stronger. Especially we notice if the company have substantial cornerstone ownership, this is a good signal. Also, the company with higher growth, even though their valuation could be high, they tend to perform better after IPO. So definitely that's reflect a risk appetite.
What trends have you noticed recently in terms of pricing and valuation?
Yeah. I think a very interesting phenomenon is we look at AH, the listed names, their H shares is launched with a lower discount to A shares, sometimes even a premium. It's a very different phenomenon compared with previously the H shares are traded with around 60% discount. Now the newly listed ones is traded with 10-20% discount. Definitely it's a reflection of the global interest in these names, especially these names are well owned by foreign investors in the Asian market already. That means they recognize their fundamental, they agree they are good companies. If they list in Hong Kong, definitely they are also willing to buy, even with a very small amount of discount.
Yeah, I think CATL is one clear example, right? Where the A shares have actually led to a premium over the A. In terms of the investment implications, do I just buy the stocks that have been listed? Do I look at brokerages? What are the best sort of investment plays around this theme?
Yeah, we see a few directions. One is clearly Hong Kong Exchange and the brokers benefit from the active market activity. And the other thing is the topical sectors which outperform the market this year, like new consumption, healthcare, technology. These are the areas people are still hold a very positive view about the fundamental. But like new consumption, there are limited number of stocks listed now. It's getting crowded, so people are looking forward to see more names in the similar area. So definitely new IPOs will attract more demand. And also the delisted names, I think they will continue being a focus.
Is it too much of a good thing? The more that companies list here, the more liquidity that's needed, the more attention it takes away from the market on the other side of the border?
Actually, we haven't seen negative spillover effect to A shares, especially historically. We see the two markets tends to be positively correlated in terms of performance and sentiment. And also this time, as I mentioned, the global funds is the key liquidity provider because their allocation in China is low in both onshore and offshore market. They definitely have abundant capital to reallocate, considering the weaker dollar trend and also some concerns about the sustainability of U.S. fiscal. So we are expecting abundant liquidity can be provided to both markets if the sentiment is recovered, if people's view about macro is recovered. So liquidity is not a big problem, but more about whether people are turning more positive on fundamentals.
If that's the case, I'm wondering, how should I look at the property space in China? I think people are doubting whether we're going to see some sort of sustainable recovery this year. Last week was a bit of disappointment in this urban planning sort of meeting that nothing really substantial came through in terms of stimulus. How should I be looking at that sector now?
Yeah, we are seeing that the property market is getting closer to the bottom, but in terms of the recovery, given the tariff impact is still negative, we are expecting some delay of recovery probably to next year. The price may stabilize, but in some top-tier cities, it began to pick up. The demand, especially the upgrade demand, is picking up. And from the July political meeting, probably we will see some reiteration of the policy support to property areas that will continue to be supportive, but it takes time.
Yep, it certainly was. Si Fu, thank you so much. Our China portfolio strategist at Goldman Sachs joining us to kick off the week. And as we talked about property there, you take a look at how this Bloomberg intelligence gauges, and really what we've been seeing for the past few weeks or months is, still a lot of doubt and skepticism of whether things can bounce back. If you take it back from about 7 or 8 years, we're basically talking about we're 80% off some of the peaks that were made back then as well. And last week we basically notched the biggest weekly drop in 4 months after that meeting didn't yield too many concrete measures to really boost demand and revive the industry overall.
Yeah, I mean, the reacceleration of losses to the downside has certainly been a poignant reminder, and the lack of, I guess, that big bang coming out of the the conference where a lot of people were expecting something worthy of a big bang didn't really come out. And it begs the question whether or not things have actually changed at all fundamentally as it pertains to the story. Let's remove the tail risks, I guess, just to acknowledge, of course, that has been, I guess, to a large extent been removed. But the underlying fundamentals, like Van Ke, for example, reminding us of that first half loss, is something to consider as we make our way, of course, into the second half of this year. To help us answer those questions, Jeannie, you are Asia Stocks reporter, is here with us to talk us through how investor sentiment has changed.
Yeah, actually, when we talk to people, I think most of them, first, the market consensus is like there's not going to be a bazooka. So not like before the urban conference we had last week, like before that, when we saw that big jump, some people were betting, okay, the government may have, like a big stimulus that's similar to what we've seen between 2015 and 2018. But right now, it's like all the policies is going to be all the easing is going to be very incremental. And we're not going to see like the bazooka we saw, a few years back. So in that case, like most of the investors we're seeing, like the consensus we're getting is like they're not going to go back to the property sector anytime soon, and it's not going to be changed, by any like government meeting. So I know we have the July meeting and we have all the upcoming policy meeting. Because to most of them, because the fundamental housing demand in China has already been met a few years back already. So even though there were many supportive measures, trying to convince the domestic citizens to buy more houses, still like the end demand is still very, very weak, considering the slower economic growth and the consumption demand right now in China. So in that case, like many investors would think this is not a sector going to give them an outperforming return. It's not a sector worth them to bet at this moment.
Yeah, I think it's interesting. Some of the analysts that your team has talked to is like, I'm not even going to touch this sector. I don't even want to cover it anymore. But then there are some that are saying, look, there are still pockets of opportunities. What are they?
Yeah, I think many of the opportunities are very tactical. So, for example, on the one hand, for some investors, the trading horizon turns to be really, really short. So some of them even do day trades. They just trade on some policy expectations and then they sell that really quickly. So it's not it's another fundamental thing. It's more tactical. And then the second thing, I think that some people are finding some opportunity among those extremely distressed names. So if those names are turning really, really oversold, there could be some short-term trading opportunities. But still, those are really, really tactical.
And tactical, I think that's the point. Tactical, it has remained for a very long time. Tactical at best. Jeannie, thank you so much. Jeannie, you there on the property story and how sentiment has changed in some ways there. Right, going into the next, first 15 minutes of the session, we're actually doing quite well here. I haven't had a look at volumes, which is perhaps indicative really of the underlying strength of this rally, but on price, we're doing better, 25,000. Is very much within striking distance. And of course, we're looking also at this metals rally that, as you can see, is extending early this Monday with iron ore prices now at multi-month highs over in Dalian. Plenty more ahead. This is the China Show. Right, welcome back. That's a look at equity markets. About 17 minutes into the cash market session now. So yes, year-to-date highs if you're just joining us on the CSI 300. And yes, 3.5-year highs on the Hang Seng Index. This intersection of the major themes, corporate earnings, thinning margins, the trade tariff conversation, you put those things together and you get a concentric circle of margins not perhaps being able to deal with the tariffs in place. And our Bloomberg Economics folks have put out this special report looking exactly at this ability for Chinese companies to then absorb these tariffs. When you look at that 40% now on average, it's a heavy blow, potentially, to the country's industry. The analysis shows that corporate profit margins suggest only 5 in 33 industrial sectors can in fact absorb the current levies. For more on this, Chang Shu, our chief Asia economist, is with us right now to talk us through this. Are sufficient profits a buffer for tariffs, and are there insufficient profits is the other question.
Yeah, indeed, if you look at the corporate profit picture, it's not great. If we look at the headline, industrial-wise, the average profit is below 15%, and it's already well below the 40% tariff you just mentioned. And you also mentioned the 5 sectors potentially with higher profits, but those tend to be domestically orientated in pharma, tobacco, mining industries. But if you just focus on the export-oriented sectors, most of those sectors have margins below 20. Most of those are in low teens. And you think of textiles and stationery and furniture, those sort of heavily exposed to export sectors, they tend to have fairly low margins. Another thing that didn't come out in the report is when we talk to exporters on the ground, the pricing dynamics is shifting somewhat. In the first trade war, most of the U.S. exporters, rather U.S. importers, shouldered the tariff cost, but this time we see more burden sharing between the Chinese exporters and the U.S. importers.
Interesting. What about when it comes to supply dominance? Does that offer any sort of protection to these firms too?
Yes, to some extent, certainly in the near term. I mean, those consumer products, for a lot of the sectors, and China has dominance, those sectors I just mentioned, and they account for over 40% of the global share. So in the near term, the supply chains can't shift that quickly. Therefore, China can, hold on to its sort of the supply to the world or external demands from the U.S. and the rest of the world. But if you look into the longer term, those sectors I just talked about, textiles and furniture, etc., stationery, the entry barrier is not especially high, right? They tend to be sort of high volume, low value sort of sectors. So going forward, this is going to be a rather challenging question that the profit picture will be very consequential both for industries and for the macroeconomy as a whole.
All right, Chang. Thank you, Chang Shu there. Our Bloomberg Economics chief Asia economist. Feel free to really check out her research there about these thin margins and really one of the most vulnerable parts of the whole export story here on the back of these tariffs. Some other stories that we're following for you today. Ukraine says Russia has launched a massive air attack using missiles and drones. Air defense officials say explosions have been heard across the country, including its western regions and the capital, Kyiv. Earlier, President Volodymyr Zelensky says his government had proposed a meeting with Russia this week, more than a month after previous round of direct talks. The South Korean government says days of torrential rain have left at least 17 people dead and 11 missing. The worst impact has been in the country's south, with heavy downpours causing landslides, flash floods, and collapsing houses. More than 2,700 people have been evacuated. President Lee Jae-myung is pledging support for affected areas, now designated special disaster zones. Israel has warned it will move the first time into a town in the heart of the Gaza Strip that it had earlier skirted for fear of harming hostages. The military on Sunday told Palestinians in Deir al-Balal to evacuate southward. Hamas, meanwhile, says a total of almost 1,000 Palestinians have now been killed while waiting for aid, including 67 on Sunday when Israeli forces fired shells. Israel says its troops fired warning shots only. Plenty more ahead. This is Bloomberg.
We're looking at fairly concrete gains on these cement names. There's a really good story. It's really well read right now of this massive project, which we'll get to the details in a moment. But yes, Morgan Stanley talking about how that specific mega dam project will benefit many of these sort of infrastructure-related stocks, including, of course, the cement plays, which are up, as you can see, in some cases 4 or 5%. Some of the engineering companies around this up similarly as well. Right, very quickly, earnings, more on this in a moment, but as you can see, a snapshot of good earnings coming through as well. First half earnings, but Yvonne is excited about one specific corporate story today.
For all the blinks out there, I know you've been listening to this song, Jump. It's making the top charts there. YG Entertainment is on the face of that, jumping as well. We're up some 6%. Ha ha. A lot of puns this segment. You're watching the China Show. Welcome back to the China Show. Here's a look at the HSI half hour in the session. It's more about really what's going on outside. A post, of course, Typhoon Wipa, which basically it kept the city at a standstill yesterday. Then most of us were at home, and everyone's kind of waking up talking about how was your T10 day. Yeah, really is what we're asking everybody this morning. But the cleanup is underway. We talk about flights being resumed, and of course, parts of Asia definitely feel it particularly hard as well. So still a lot of ongoing issues there too.
Yeah, maybe just to help out the public service announcements, because I couldn't go for my usual Sunday runs. I went for one this morning. So a couple of trees that actually fell on the usual harbor front running path. So
scaffolding too. Have you seen some of those videos out
there? Yes, yeah. Where was that though?
I don't know.
Yeah. In Kennedy Town, there was a ship that was slamming against the port. By the yacht club, there was a tree that actually was right smack down into the street. Yeah. So that actually is something to, anyway, that's about inside baseball. But yes, certainly, hopefully, that flights have resumed. If not, some of the flights that were canceled almost completely on Sunday have now resumed, if not the backlog cleared completely. Now, speaking of the markets, get into this right now about a minute late, the Hang Seng Index is actually doing quite well, 25,000, 5,600 on the Hang Seng Tech. This does, though, in many ways, flip the page, please. Don't forget that the Singapore market has done extremely well, is doing extremely well. Again, it's outperforming again, 0.6%. In fact, I think the chart that's going to come up on your screens very shortly. Can we get the chart up of RSI, please, if we can? That's actually now trading at 14-day RSI. It's now 90, which is a level that we haven't seen as far as Singapore is concerned. So highest level on record. Longest win streak in
19 years.
In 19 years.
But as you say, it's not just a Singapore sort of happy story, right? You're seeing that in the Kospi. You're seeing that in Hong Kong, where we're getting closer to 25,000 on the HSI. And you're seeing the S&P, right, continue to hit record after record. So is this just plain complacency, or, is there really something that's supporting this? I think the NVIDIA trade and all that really kind of helped and lifted all these gauges last week as well. Maybe there's more to that here moving forward. But you talk about commodities, right? That's also looking pretty hot these days too.
Yeah, Dalian. So you have zinc in China, the Dalian iron ore contract is coming up on your screens. We haven't seen an 800 handle on this one specific contract since I think Feb of this year. So yeah, we have been testing multi-month highs as far as this one are concerned, and it really underscores, I guess, is it complacency, or are things actually doing better than the headlines actually suggest?
Yeah, let's get to our top story. So you mentioned about Japan. The Prime Minister Shigeru Ishiba says he will stay in office despite NHK reporting that his ruling coalition lost its upper house majority in Sunday's election. This marks the first time since 1955 the Liberal Democratic Party will govern without control of both chambers. Let's bring in Japan and Korea's economy and government editor Yuko Takeo. She's with us here right now. Yuko, it's as polls predicted, but this is a bad result for Ishiba. What happens from here?
Yes, so Ishiba has missed securing a majority with just by 3 seats. So the results are a little bit better than the polls initially predicted, but the bottom line is that he's lost control of upper house, and that's a historic result. Ishiba's already said multiple times last night that he'll stay on despite the result, which suggests he'll have to somehow cobble together enough support from opposition parties for now to pass legislation on an issue-by-issue basis. That means he'll likely have to make concessions to opposition party demands, meaning more fiscal spending in some form is likely. But given the historic nature of the loss, it seems difficult to see Ishiba remaining in power for much longer. All 3 LDP prime ministers who lost an upper house majority have left within 2 months, and it's hard to see Ishiba breaking from that mold.
All right, so let's write out those scenarios then. And one path takes me to the opposition and the possibility, talk to us about this, could the opposition actually, or opposition parties, plural, take over?
Technically, this is possible since they hold more seats than the ruling coalition, but it seems like a very remote possibility given those seats are split between a dozen or so parties that are very unlikely to be able to come together to form a government. It would probably make more sense for them to try and influence policy through the leverage they have over the ruling government as the LDP struggles through for now, and wait for the next general election to consolidate more power.
Yeah, and Yuko, it certainly complicates, I'm guessing, what these U.S. and Japan trade talks are going to look like, right? If we start to see, this leadership in question. What does this mean, right? The country's still facing the prospect of higher tariffs amid all this. What happens to trade talks now?
So the trade talks and the prospect of higher tariffs, that's something that's been hanging over the election as well. And basically it remains unresolved. Japan is set to face across-the-board tariffs of 25% from August 1st, barring a deal with the US. And so far, there's been nothing concrete to show after Japan's chief negotiator, Hirose Akazawa, has already flown to Washington 7 times. He's set to go back to Washington this week, it seems, but now the ruling coalition and Akazawa will have to continue negotiations with the US from a weaker domestic position, with the deadline for higher tariffs coming up in just 10 days.
All right, Yuko, thank you so much. Yuko Takeo there, our Japan and Korea's economy and government editor with the latest and the potential implications, of course, of the Japan story. I should also add cash markets are shut in Japan today, and 2 other things on the agenda on Japan this week, which is the JGB auction 40-year that's on Wednesday, and Tokyo CPI comes through as we wrap up the week in a couple of days on Friday as well. Right, some news coming through right now out of this is to pivot here to China's Ministry of Commerce, and lines coming through here that China is now looking. Well, number one is that the EU's Ursula von der Leyen will be visiting China on the 24th. That's in 3 days' time. That China's vowing necessary measures to safeguard their firms' rights, and of course, it's gotten a bit touchy as it pertains, of course, to this side of the conversation. Not to also mention, since we're talking about the EU and the US, also some headlines there as well. I guess it begs the question right now, right? We are getting more progress in these trade talks. Yes, you have sticking points like Japan, which is a story that we can get to later on. But does this mean the path for rates will be more neutral, or will central banks need to even lean further into the rate cutting cycle despite the progress we're seeing on these new tariff deals? Let's bring in Jason Pang, here with us on set, Asia Fixed Income Portfolio Management at JPMorgan Asset Management. Good morning. Nice to see you.
Morning. Nice to be here.
Can we start with that? Rate cutting cycle, we're getting more good news on trade front, not completely, but do you think one derails the other?
So I think overall, in terms of the rate cut story, you're Japan or the state side?
No, everything else. Asia Pacific. Okay. Asia Pacific.
Okay, so
Korea,
I think,
Malaysia, what have you.
Sure, of course. So I think broadly speaking, if you look at the Friday comments from Waller, the bottom line is there will be further easing potentially coming through into the month of July. I think for Asia, then when you take into account the trade deals, people are talking about that relative, positivity on some of these tariff deals being lower than expected. But when you look at it on an absolute basis, there will be economic impact. You may not see it today, but you're going to see it within the next quarter or two. And I think when you look at that, you add that to overall the sort of China PPI story that's still coming through into the region, then I think the rate cuts that are being priced in right now can actually come in much lower than what people expect. So if I use Malaysia as an example, or Indonesia, I think the market is probably expecting another 25 bips cut over the next 3 months to 1 year range. We're actually thinking it can be much more severe in the range of 50 to 75 basis points.
Okay. How should I look at local currency bonds then now? Is it getting more traction? What are conversations with clients like now?
Sure. So in the companies that we meet and the clients that we discuss, I think the topic on the dollar has become much more broader based. There is a degree of concern at the management levels on how to sort of, navigate this overall dollar trend. So I think the way that we can think of it and the way that we've communicated is near term, there's no sort of big alternative liquid currency compared to the dollar. So near term, then I think what the message really is, the dollar will remain sort of a mainstay in terms of any currency portfolio. But over the longer term, and we started seeing that in some of the allocations into euro by the central banks and also these other currencies, is you do need to be looking at a currency allocation. And that's a weird topic because no one's really looked at currency reallocation given the strong dollar for the past decade, but it is coming back. So I think the way that we would look at it is you start to need to look at active management currency on a forward-looking basis.
Is that the only driver behind these local rate story, for example? Is there anything else idiosyncratic within this trade that might tell you that there's more to this trade than simply a weak dollar?
So if you look at foreign currency deposits in the likes of Malaysia, and I think Taiwan dollar, you might have saw the 20 Sigma events a few months back.
Yeah.
I think basically there is a realization now that there is a lot of foreign currency deposits in most of these Asian markets. And hence the question then becomes, when do you need to liquidate that? And of course, then you wouldn't liquidate unless your carry trade on the dollar being higher yields versus your local rates actually overrides the capital loss. So I think what I'm trying to say is if currencies start appreciating much more materially from here, you're going to see accelerated liquidation, and that actually can procure a stronger Asian currency within the region.
How should I be looking at long rates right now? It seems like whether it's Japan, whether it's the U.S., it's really causing a lot of, as a catalyst for how, credit, how, bonds perform. It's not really so much about the easing cycle anymore, per se, or what the shorter end of the curve is doing. Is this sort of a new regime, you think, that you see?
Sure, Yvonne. So I think we need to categorize this into two different ways. When you look at the steepening and the fiscal concerns that you're talking about, a lot of this is actually sort of coming through in the developed markets, whereas that's resulting in the 1030s steepening that you see in JGBs and U.S. Treasury and all these other currencies, right? But when you look at Asia, actually most of these curves have actually been rather flat. And if anything, some of them have been flattening. I think, China is one of the more classic cases. But even if you look at the ASEAN's currency markets, actually most of these curves have been flattening. So I think the dynamic really is that on one side, Western world is more about fiscal, concerns on inflation. But in the region, it's actually the other way around, right? You're thinking about, how do I navigate deflation, lower inflation within the region, lower growth outlook. And all of that is actually sort of getting reflected into the long end curves. So if anything, then what's actually happening is we're quite bullish on the local rate stories, and you're able to monetize that macro theme relative to the rest of the world.
And, as an fixed income allocator like yourself, how are you managing your exposure in your different strategies to those long-dated bonds, for example, which, I know some of your strategies might have bits and pieces of those securities?
Yeah, sure. So I think just, talking about that and going back to the examples that I mentioned on the thematic differences, what we're basically running to some degree is a steepening on developed markets, and then we're running flattening or overweight duration in the local markets.
I have to get your take on Japan. I know you don't have, maybe a strong view, but I mean, how difficult is it now to really kind of navigate what happens with dollar yen, for example?
So I think on dollar yen and even the JGB in particular, the dollar yen side of it really suggests that, the yen's been weakening at the same time where the 1030s have been steepening.
Yeah.
So I think, when I look at the overall fiscal concerns, that is definitely reflecting into both the currency and the curve market as well. So in that same regard, the results of the elections do suggest that perhaps more curve steepening does come through. And it doesn't necessarily benefit in the same way with regards to the yen. And if anything, then if you look at the overall inflation indicators, BOJ will remain hawkish to some degree, but I don't think it's enough to offset this concern on the fiscal. So I think to us then what we see is, the 1030s is recognized very steep, definitely, and we'll sort of see how the cash markets react tomorrow. But I think at the same time, at least to me, then it can end up being a value trap. So we're not necessarily engaged in this market because we don't see high Sharpe ratios, and we see a lot more opportunities within the region to invest in.
Right. I guess a final question on JGBs before we talk about, I guess, the Fed as well. Let's say, for example, the JGB market dislocates even further.
Okay.
Will that have any global consequence? In other words, how much should I care about what's happening in the JGB market?
I think at this juncture, then, there's too many of these multi-sigma events to account for, where I think that over the summer, the market has basically ran out of bandwidth to reflect that. So I don't believe, on the personal level investment, that a JGB steepening further or JGB losing control will result in the massive vol gap downs that we see.
Okay.
Yeah.
One thing we haven't talked about is obviously the saga between Trump and the Fed chair, Jay Powell.
Trump security.
Yes.
How should the market interpret that? Should we start repricing what a potential new Fed chair would look like?
So I think if you look at what's been happening with the MIPR or one-year Treasury pricing, it's been basically priced to 100 bips cut. Right, but you guys extend that to the 2 to 3 year, which is where this uncertainty comes from. Nothing's actually in the price, but when you look at what the government says, or what the presidency says, the long story is I want cuts, much lower interest rates, right? So if you sort of look at that and you look at it going like, okay, well, there's an 8-month timeline to sort of a chair shift. Yeah. Well, the chair will probably be more dovish than the current one, which means that what you need to think about now is not only the 1 year, but how do I actually monetize the 2 year? So I think what we're thinking now is your 5-year treasuries or 5-year credits are probably the sweet spots where we think that more can be in the price as you sort of move into the option expiry.
How is it one cut at best that gets priced in? If suddenly there are bigger questions around his job security? Like, in other words, how much more can the other guy or the other person then that follows Jay Powell actually cut incrementally more?
I think it depends who
or what's the trade, right? So
I think it's hard to say like with the certainty on who becomes the next chair per se, nor the timeline. So it's hard to speculate on that. What I'm trying to say then is 1 year is priced for 100 bips.
Yes.
2 year is actually priced for the same. So to me, when I'm looking at that trade, if I'm thinking a more dovish chair can imply another 50 basis points cuts.
Okay, there it is. Okay.
Right?
So
then you buy the 5-year treasuries, you buy the 5-year credits, and you sort of go along the interest rate sensitive trades such as Hong Kong dollar rates and all those other ones.
Jason, it's great to have you.
Fantastic.
Jason Pang there, Asia Fixed Income Portfolio Manager at JPMorgan Asset Management. Still ahead on the China Show, we take a deep dive into China's climate strategy and the push towards decarbonization. Plus, Swiss Re explains why extreme heat is now the deadliest natural threat in the APAC as the population ages. We have much more ahead. This is Bloomberg. All right, we're focusing a little bit more on these price wars, food delivery apps, and the like here. And you're seeing the likes of Meituan up some 4%. Why? Well, what we heard over the weekend was the Chinese regulator summoning the likes of Meituan and JD and Alibaba's Ele.me, and to basically say it's time to kind of get your act in order here and maybe put an end to these price wars. That's why you're seeing that massive bounce in some of these stocks here. Let's bring in our China correspondent, Min Min Lo, on what we heard. And what are some of the steps towards maybe more rational sort of competition now in this space?
Yeah, we have been getting increasingly a lot more signals from the Chinese government, right? You have the State Council, Premier Li Qiang talking about reining in competition. You have President Xi saying that it doesn't make sense for all of these regions to really pile into the same few industries like AI, EVs. State media also saying that some local governments are giving out illicit subsidies and wasteful investments into these sectors. So there were two big meetings that happened last week. One was between the government ministry and the players in the EV sector, and then the other was between the market regulators and the three big food delivery firms like Meituan, Ele.me, Alibaba, calling them to rein in that excessive competition, telling them to boost their market share by investing in product innovation rather than price cuts. Now, there wasn't a lot of detail in terms of how this is going to be implemented, whether it's going to come in the form of penalties or other ways of enforcing them. But bear in mind that many of these companies, they are private companies that are willing to basically get more market share, push up their top line at the expense of the bottom line. Already, we have seen analysts revising down the growth forecast, the earnings forecast, I should say, for some of these food delivery riders as a result. So, of course, the headline now boosting some of these share prices there. But the big question is how will the government be able to boost spending power in the longer term for people so that these companies won't have to resort to such lengths to gain market share?
And this goes into this Bloomberg story we're about to talk about, right? So the ability for the domestic market to expand, to then be able to absorb, a lot of the capacity. It depends on what side of the political spectrum you sit on. If you're outside, you're saying, oh, there's overcapacity. If you're inside, you're saying, oh, there's a domestic weakness, and you are getting domestic weakness evidence from these price wars. But it goes into this Bloomberg interview that we did with a senior Chinese official that says, when you look at the trade policy and industrial policy, it's within reasonable bounds. What can you tell us about that?
Yeah, so this came from Leyen, who is the vice finance minister. He is a key member of the negotiating team that met with Scott Bessent in London and Geneva. And he is saying that, yes, China, its production, it looks like overcapacity from outside, but he says it's really unfair to look at one sector and the Chinese market share there and determine that there is overcapacity. He said that's an oversimplification. It doesn't really capture the reality of the Chinese economy. And he says the government has been making the transition for the economy to shift towards a more consumption-led one. And he says there are statistics to prove it. If you look at the consumption share of GDP, it's risen to 56% in the last 4 years, quite significant increase compared to below 50s in the previous 4 years. And he said the government will continue to expand that by strengthening the social safety net, the pension system, increasing the amount of jobs created, increasing salaries. They did that for civil servants sometime not too long ago. So I think the government is trying to do that to boost the spending power in the long term. And he's saying all these ahead of the expected meeting that he will have with Scott Bessent and Howard Lutnick to kick off the next round of trade negotiations between U.S. and China.
All right, Min Lo, our China correspondent there with the latest. Some of the stories that we're following for you today. The Washington Post is reporting that a Chinese-American employee of the U.S. Commerce Department has been barred from leaving China since April. Now, according to the South China Morning Post, he traveled there to visit family and was detained when he arrived in the city of Chengdu. The Post cites sources saying the man is being held because his case is linked to actions Beijing considers harmful to national security. President Trump and Xi Jinping are reportedly expected to meet at or before the APEC summit beginning at the end of October in South Korea. Also, the South China Morning Post citing sources saying that Trump could make a stop in China on his way, or they could meet on the summit sidelines. Sources have told Bloomberg that Trump has been dialing down his confrontational tone with China in hopes of securing a summit. China is tightening controls on critical mineral exports, pledging zero tolerance for smuggling and illegal shipments. State broadcaster CCTV says Beijing's Export Control Office flagged recent cases involving false declarations and transshipments through third countries. China is enforcing stricter licensing for all rare earth shipments amid ongoing trade tensions with the U.S. Plenty more ahead. This is Bloomberg. Some stories that we're following for you today. Private equity firm Blackstone has pulled out of a bid for a stake in TikTok's U.S. operations. A source says the firm has offered its potential share to other investors in a consortium that includes Oracle, Andreessen Horowitz, and General Atlantic. An ownership shift is needed to split TikTok from Chinese parent ByteDance ahead of a mid-September deadline. Israel has warned it will move the first time into a town in the heart of the Gaza Strip that it had earlier skirted for fear of harming hostages. The military on Sunday told Palestinians in Deir al-Balal to evacuate southward. Hamas, meanwhile, says a total of almost 1,000 Palestinians have now been killed while waiting for aid, including 67 on Sunday when Israeli forces fired shells. Israel says its troops fired warning shots only. Ukraine says Russia has launched a massive air attack using missiles and drones. Air defense officials say explosions had been heard across the country, including its western regions and the capital, Kyiv. Earlier, President Volodymyr Zelensky said his government had proposed a meeting with Russia this week, more than a month after the previous round of talks.
Okay, Yvonne knows more about this story, but YG Entertainment, what's the name of the song?
Jump.
By Criss Cross.
No, you're dating yourself. Blackpink,
That's the better crisscross, though. That's the better jump. Anyway, there we go. Stock is jumping. AMP, Aussie Life Insurer, also doing quite well today. Speaking of life insurers, Swiss Re joins us later on in the show. Plenty more ahead here on the China Show.
This is sort of the second punch that Ishiba has taken. I think it's very hard. He was already on shaky ground. He's even on more shaky ground to remain as prime minister. He's vowed to do so. We'll see what he says at his press conference today. But, Taro Aso, very influential member, former prime minister, has already said that he wants to push him out. So I think there's going to be, the knives are coming out, and we'll just have to see if he can hang on. It's not going to be easy.
What the Japanese economy really needs is support for both the demand side and the supply side. The Japanese economy is now in a place where it gets more difficult to grow through exports because of the deteriorating trade environment, tariffs in the US, tariff threats from the US. So Japan will need to find a way to generate more homegrown demand, if you will, to grow going forward. And that requires both demand support and supply support. And that is not something we've seen from either the opposition or the government.
Some of our guests this morning on Bloomberg, and Japanese markets are closed for a holiday for Marine Day, of course, after this upper house election, which did deal a pretty historic setback for Ishiba and the LDP party. But if you think about the market reaction is so far, I mean, with Japanese markets shut, though, there are some proxies we mentioned. But overall, it's been pretty much a snooze fest if you take a look at how the market reaction has been. Bond futures, Nikkei futures are pretty timid here right now. Dollar yen, we briefly saw that strength. We've kind of reversed a bit, but we're still seeing a little bit of strength, but not a whole lot. But yes, there's still a lot of questions on what this means, right? You know, of course, Ishiba's fate, but also we also have that 40-year bond auction later on this week as well, Dave.
Yeah, following the latest one that came through, and this is going to be big news because I think the key narrative here is there's really no visible replacement for the BOJ to backstop demand. Yes, we can talk about fiscal consolidation. Yes, we can talk about fiscal health. Yes, we can talk about the inflation picture, which is, by the way, adverse to being long JGBs. But all things equal, right? Is there a global consequence to melt up in JGB yields? 40-year auction coming through, and the demand as well coming through. We'll get a better indication of that, of course, midweek, and of course, inflation comes out as well. Out of Tokyo later this week. Right, the rest of the region, though, it's a quiet day across these markets, with the exception of a few sort of regionally focused themes, like Singapore is one. In Hong Kong, within Greater China, its turnover is picking up. You have on price CSI 300 is doing well. Hang Seng Index 25,000. The platform companies are doing well on this, on being summoned, and maybe a glimpse of a stronger emphasis to end the price wars there. We can set that aside. The other big China story we're tracking here is this EU conversation, EU-China on climate. You have Chinese President Xi Jinping scheduled to meet senior EU leaders in Beijing. That's on Thursday. Range of topics: geopolitics, trade, economic, hanging over the summit. One subject where they might actually find common ground is climate. Now, Beijing has said it does seek deeper climate cooperation with the EU and will seek promoting low-carbon development. Joining us now from Beijing is the chief China representative at Greenpeace East Asia, Yuan Ying, to talk us through the implications and her expectations ahead of this meeting this week. Yuan Ying, good morning, and thank you for joining us. Why don't we start with the meeting taking place that seems to be where the low-hanging fruit is between the two sides. What are your expectations ahead of the meeting?
There are definitely high expectations on this summit because of the global climate movement is encountering a lot of challenges and barriers, right? After Trump's decision to withdraw from Paris Agreement, we have seen the multilateral climate process is challenged. So in this critical moment, we see China and the EU are the major players to play active leadership to drive this multilateral process ahead. So, but we have also noticed that there are blocks between the two sides surrounding the trade, surrounding the CBAM issues. But we also have seen a lot of the mutual interests and the common ground between the two sides. So the two parties can collaborate more on the global green energy development and also on the global clean tech solution providings. So we see more common grounds and more interests than the blocks. So we are looking forward the two parts can have a constructive communications and play more active leadership around the global multilateral process.
Right, and how does it fit into the bigger picture here with President Xi with their climate goals, right? The peak carbon dioxide emissions in China by 2030. What sort of confidence does Greenpeace have that China has at least maybe approached or even getting very close or even broken above that sort of milestone already?
Yeah, we have seen the President Xi has announced the 2 carbon targets in 2020, right? And in this April, we have seen the President Xi has announced again in the United National Assembly again, emphasizing China is producing a very comprehensive climate reduction plan, including the whole economy sectors and also covering all the greenhouse gas emission. So we are hoping this strong political willingness is granted. And also we trust China has this capability to move things forward. For instance, in 2025, in the first quarter, we have seen the milestone renewable energy installation capacity happening in the grid system. So now we have, for the first time, the new generated electricity from the renewable energy has met the new increased electricity demand. So that signals a milestone timing for China to pick the power sector quite soon by 2025. So there's no room for the new added coal power plants, and we are on the right track to get the emission peak.
And, it is the time of the year. I'm going to bring in the recent temperatures, which have been on the higher side of things. If you could tie into, the need to discuss solutions in light of this heat wave that's been taking place, Ying.
Yes, indeed. In the past months, actually, we have seen record high temperature happening around the country. So in the past months, we have seen the official data from the China Meteorological Administration. The past months has 1 temperature degree higher than the average. And this heat wave is widespread and has a long duration across the country. So it affects provinces like Shanxi, Henan, and Hebei provinces. And we have seen the reporting of high temperature going above 40 Celsius degree. That's something really huge. And in the July and foreseeable in the coming August, we can see the heat waves are getting worse and worse. So in the July, we have seen more than 11 cities have reported this temperature going higher than 35 Celsius degree, covering actually 900 million people across the countries. So it's bring the higher risk of heat strokes and also affecting people's health in a larger way.
So, Yuan, what's your assessment of China's work in climate proofing then, and being more prepared in case these sort of natural disasters and heat waves happen again?
Definitely. I think we need to do on 2 directions. The first direction is very important. We need to continue the mitigation actions to deal with the emission concentrations. So we need to decarbonize the power sectors to reduce the emissions from the power sector from the coal power plants. That is the uppermost things we need to address. And meanwhile, when we are achieving the power sector emission peak quite soon, we need to see the structural decline of the national emission, right? So that is referring to multiple measures addressing the emissions from for instance, heavy industries from other sectors. And meanwhile, we need to enhance our capability in dealing with this kind of nationwide climate crisis. We need to enhance our adaptation capabilities, especially on the local communities and on the local grounds.
Right. And just to look at the other side of it, too, I mean, certainly more work needs to be done in China and many places in the world. But just also to ask you, where do you think China has made progress on substantially the best practices that the rest of the world can take. Because here in the show, we talk about how, EVs, for example, are world leading. There's a big story on the weekend, hydropower, this mega dam project that China's embarking on. And I wonder, within the longer term story of trying to balance its energy mix, what substantial progress do you see still happening on the positive side?
So on the mitigation part, I think China has bring the milestone growth on the renewable energy growth. So like what I said, right now, until 2025, we have seen the wind and solar capacity generated is amounting to more than 1,400 gigawatts, right? So that is already surpassing the coal power plants capacities. So we have a rationale behind it. If the newly increased electricity demand is going to be met by the renewable energy instead of a thermal power capacity, that signals the emission peak of the power sector. Not to mention, we are talking about the electric vehicles, robust growth, right? Both in China and also China's exporting to other markets, including the global south markets. So including wind and solar and electric vehicles and even batteries, I mean, China is bringing the clean tech solutions not only in China but also to the global markets, especially those global south markets, also helping to speed up the decarbonization process in that regions as well.
And it brings a lot of questions about leadership, right? What does Greenpeace see? Do you think China can take a greater global sort of climate leadership role now that the U.S. has taken a bit of step back? And how do we see that, in terms of evidence and how this actually translates into action?
Yeah, there's definitely expectation on China, including EU and also other emerging countries, to play an active leadership, right? So when we talk about the case of China, we see China has a capability and also the competence in terms of its robust clean energy growth and also other clean tech growth. So we definitely have the confidence that China can play the more active leadership on this global multilateral processes. But meanwhile, we wanted to see China and the EU and also other players, including Brazil, the presidency of the COP30, and other global South countries. They can go hands in hands to play the active leadership to fill in the void left by the U.S.
Yuan, Ying, it's great to have you. Thank you so much for joining us, China Chief Representative at Greenpeace East Asia. We got plenty more ahead. This is Bloomberg.
All right, these are the pockets of strength we're seeing across these equity markets. There's not a lot. Well, for one, Japan is shut, so take that out of the equation today. A lot of interesting themes have emerged recently. When I say recently, last 2 weeks or so. So the Hang Seng has broken out of its range. That's past tense. Let's see if it manages to stay above that closing price on Thursday and Friday. As of Friday, 3.5-year high on the Hang Seng Index. CSI 300 high since November 2024. Singapore's been red hot. And South Korea has just been upgraded, I believe, to equal weight out of Morgan Stanley. So it's not just a Singapore story, as Yvonne is pointing out, right? There are really pockets of strength across many parts of the equity market. Global stocks are coming into this week already at a record high.
There's a really good story in the terminal talking about, it seems like equity markets are just kind of brushing off some of these tariff risks and the like, but there's some key sort of voices that are saying maybe we are underpricing some of the tariff risks and what's happening in the second half as well, because we already assume now that those effective tariff levels are going to be higher, right? Chang Shu from Bloomberg Economics is already talking about, 40%, that number could already be quite disruptive when it comes to margins and the like here for many, many sectors.
I think it's 3 out of 22, I believe, 3 of 22 sectors that they have surveyed that are only able to deal with the tariffs. And, the issue, though, is most of the sectors that have the margin to deal with the tariffs are inward looking. So in other words, you will get an export hit. The other issue there, though, is, to what extent really are when you're an investor, your large caps, right, your BYDs of the world, to what extent is that actually exposed to what's going on in the U.S., because that's really not a big market for many of these exporters coming through. And, whether that's China, whether that's this interview we did with the vice finance minister who defended China's economic policies and the overcapacity issue, and he's pushing back against that and say it's within reasonable grounds. There is a domestic market that, while weak, can grow into absorbing that excess capacity. Is not the big of an issue. But it's when you get into the realm of politics, everything doesn't seem to be objective. But I think that opens up a lot of complicated doors.
All right, we were just talking to Greenpeace about overall climate change and really the challenges in really slowing the speed of climate change as well. Extreme weather is also changing that landscape for insurers as well, with Swiss Re saying that extreme heat is now the deadliest natural peril. Now, joining us exclusively now is the CEO, Life and Health of Reinsurance, Paul Murray. He's in China to, of course, meet with clients here. And Paul, it's great to talk to you. Tell us a bit more about your trip to China in particular here, and what's really on the agenda, and overall, how does it fit into your expansion plans here in Asia?
Yeah, good morning, and good morning from Beijing. It's great to be here. I'll be spending a week here with our clients, also meeting the regulators and our team here. Our business is very long-standing here in China. We've been here now for 95 years, actually, trading, so getting close to 100 years. It's a very important part of our business. Compared to other markets, it's the third biggest market, actually, globally for us, so very significant, very important. We're very committed long-term.
Okay, well, 95 years is a long time for any business really to let alone exist, let alone be in a specific market, which of course you guys are in there right now. Can you talk to us about specific opportunities you're looking to leverage this year and next, Paul?
Yeah, absolutely. Yeah. So, our role really in the world, in particular in the insurance world, is to absorb significant shocks. And we do that by spreading risk around the world. So it's ideal for us to have a presence in as many countries as possible, and also in as many risks as possible. So really, if you think about wherever there's new emerging risk in the world, and specifically in China, we want to position ourselves to participate in that risk. And to be able to do it in such a way that makes it accessible and available to as many people as possible. It's in our interest that more people become insured. So over the time we've been here, we've done a range of different risk coverages for individuals, for companies, and increasingly for governments and government departments where there's natural catastrophe exposure at a much larger scale. So we try to make sure we're available to help in all these situations.
I believe there was a media roundtable that you guys did last year where senior executives mentioned that China, India, these were going to be key markets for you guys to make up the bulk of contribution when it comes to life and health insurance premiums. Is that still the case, and why?
Yeah, absolutely. So for life and health, it's the fifth largest market, and we have some very, very developed markets around the world. China's life insurance market really has only started taking off in the last 20 to 30 years. So, for some of the markets which are 150, 200 years old, that's remarkable progress to already be at that level. And we anticipate that to continue with very strong growth here over time. One of the major factors, and I think this is going to be the biggest life and health risk going forward, is the one of aging. So if you look at the China population today, 20% of the population are already over 60. Now that's a huge part of the population, much more than it was in the past. In the next 20 to 30 years, that will double to 40%. And it's not hard to imagine. You don't have to be an insurance specialist to understand the impact that will have on society. Now, from an insurance point of view, of course, we then have a role to try and prepare people to think about the risks associated with longer life, aging, the health-related risks, and how families can think about how they're going to support different generations. Potentially, as we get older, we'll have two generations of parents and grandparents living with us, and that becomes the norm, and have to support them. So how can we make sure that people prepare for that properly? That's where we play a central role.
Right, and as on the other side to that same coin, Paul, is how does that affect duration matching on the part of investments, for example, if durations on that side are extending, I wonder if that's having any material impact on how you look at, say, being able to match that properly.
Yeah, that's a really good point, actually, and this is one of the peculiar things about long-term business, where we take risk that can be for decades, maybe up to 100 years actually long. So we're taking these very unique bets on the future. So we build up these long-term liabilities. Now, in order to manage our balance sheets, to make them stable over time, the perfect situation is to have assets that match these liabilities with the same duration. And that means that when interest rates move, both of them go up and down at the same time. Now, you need to have the access to these long duration assets in order to do that. And in China, for example, the average duration on the asset side is about 6 years. The average duration at this point on the liability side is 12 years. So actually you can't perfectly match. This is a problem. It's a problem for insurance companies as well, particularly when interest rates are falling, because that's then pushing the liability up more than the asset because it's shorter. So this is a real problem. And I think one of the things is, we can help with mechanisms that help hedge that risk. So we help insurance companies with that. But we also encourage the government and regulators to think about, how can we have assets that will be longer over time? How can we have government debt that's longer duration or private debt? And this will become a bigger problem, of course. Due to my previous point, as people start to live longer, we'll have longer liabilities, and then we'll need longer assets. So we can't really wait in order to address this.
And overall, there's so much debate about whether it is now time to look and shift away from U.S. assets, or even just questions about the dollar. How does Swiss Re look at, this market in particular, particularly when it comes to U.S. Treasuries and U.S. stocks?
Yeah, well, we aim as much as possible to match the underlying insurance risk with the local currency. And that's, again, it's one of these principles of matching that you aim to do that. So we have an active investment policy in China. We have a team here, as in most countries around the world, that are working towards doing that. We're fairly neutral about currency risk overall, but making sure that we match that and do it very well is important to our success. It reduces the volatility of our numbers.
Paul, just a final, let's try to end on a positive note, and I want to get your comment on, I'm not sure if you've seen the Morgan Stanley note about a month back. The golden era for reinsurers is over. The cycle has clearly started to turn. Positive pricing, top-line growth is pointing down. Just a quick comment on that, Paul, if you could.
Yeah, sure. So in our business, there's two sides to it, really. There's the life and health side, which I'm the CEO of, and the P&C side. And life and health doesn't have that cycle. So actually our role for the group and for the market generally is to bring stability. Our outlook is actually quite positive. As long as there's economic growth, then our business has a positive outlook. Now, I would say growth in China has slowed down a little bit this year, right? It's still positive. It's very good. Right. But I think due to a range of pressures on consumers, it's slowed down a bit. But we do expect it to bounce back.
Paul, thank you so much for the time. CEO of Life and Health there at Swiss Re. Thank you for joining us. We'll see you all tomorrow.